Hello and welcome everyone to this edition of Insights from the PM's Desk. Today we're going to talk about interest rates and how the private credit market has responded to the significant shock in interest rates over the past quarter. So as you're well aware, in the US, we have had significant interest rate increases in the last 6 months, roiling equity markets and really affecting every single asset class. Here at Carlyle Global Credit, we are focused on the private credit markets. So I want to talk a little bit about how private credit has responded. As interest rates have increased, our base rates have increased. The vast majority of assets that we invest in at Carlyle Global Credit are floating rate assets. So as LIBOR and SOFR rise, we capture that increase in the amount we are being paid by our borrowers. Base rates for us right now are the highest that they have been in nearly a decade. Now, spreads have also been increasing due to macro volatility and the general sense that we may be headed for more difficult economic times. If you combine these two things, higher spreads and higher base rates, you can see that the yields that we are being paid are the highest they have been since the COVID crisis, and before that, since the great financial crisis. Simply put, we're being paid more to take risk today than we have been in a very long time in the private credit markets. But let's talk about credit fundamentals. Default rates today are still at historic lows, below 1%, compared to long-term averages of more like 3%. We are also seeing strength in interest coverage ratios. One of the great concerns we have as private credit investors is that as that base rate goes up and as spreads widen, companies won't be able to meet their interest payments. Well, so far, we're not seeing that. Compared to historical averages, interest coverage ratios are actually very, very strong. At the same time, we're seeing leverage levels that are in line with historical averages. We haven't seen the type of increase in leverage across our borrowers that we saw in the great financial crisis. And finally, fundamentals remain strong. Revenue growth and profitability are still in line with historical averages. Companies are still able to have a strong operating margin even in this environment. So fundamentally, with default rates low, interest coverage ratios strong, and leverage levels in a decent place, we feel very good about the credit quality of our portfolio. Now, going forward, we're going to be very, very focused on these metrics as we get numbers from Q3 and Q4 to make sure we identify any early signs of volatility in our markets. So now let's talk about inflation. So the bad news is that inflation remains elevated based on the data that we have at Carlyle from all of our borrowers and portfolio companies. Now, the good news is it's starting to abate. We're seeing that in places like output gap for durable goods, which is narrowing, and the price of shipping containers, which is a good indication of what it costs to get a good to a consumer. Both of those metrics are starting to look better for us, indicating that inflation may be abating. We're also seeing normalization in services. For instance, the US passenger index for airlines is up, and hotel occupancy rates have started to normalize close to pre-pandemic levels. All of these are signs that the economy is coming back, that inflation may be abating, and we hope to continue to see those trends over the next 12 to 24 months. As the world navigates this new high interest rate environment, at Carlyle, we're focused on deploying our capital into great companies that we believe will perform well through cycles. Thanks again for joining this edition of Insights from the PM's Desk, and we'll see you next time.